Your business did 20 crores of revenue last year, but you're still struggling managing your working capital. I have worked with more than 200 plus companies and have found that 83% of companies do not have formal budgeting process. And in this video, we are going to talk about how do you create a budget. Budget is something which has never been taught anywhere. And that is the sole reason a lot of business owners are not been able to implement annual operating plan in their company. All right. Step number one is defining your assumption first. A lot of founders, what they're going to do is they're just going to jump to an Excel sheet and start creating a budget. But before that, I would tell all the founder to pause, get your past data in place in terms of what was your performance for past 2 or 3 years. Have a trend analysis in terms of how you have grown your revenue, how your profitability has achieved, what is your cash flow movement month over month. So let's get into an Excel sheet wherein we are going to talk about how do you practically create a budget for your organization. This is an assumption sheet wherein you're going to put down your company name, a financial year for which the budget you're going to prepare. For this, it is going to be 26, 27. What industry you are in. Let's say I'm into the service industry, GST registration, and currency is Indian National Rupee. We are going to hit to a revenue assumption. Let's say for me, I'm making 25 lakhs every month and I'm expecting a revenue growth rate of 3% every month over month. And typically for my business, I expect a quarter three where is a dip of 10% as compared to my other quarters. Okay. The beauty about this Excel sheet is it's so dynamic in nature that any changes you make in this assumption sheet will ensure that all the Excel sheets, all the calculation, all the formula gets updated. Okay, collection period. So based on my past data, I've identified that typically my customer pays after 45 days when I raise an invoice. The bad debt provision, typically 2% of my customers do not pay me and GST rate output is 18%. Then I'm going to put my cost assumption, is what is my raw material cost, which is my direct cost as a percentage of my revenue. How much employee do I have got? I have put in 15. What is my average CTC per employee? Currently, it is 4,50,000. I have a hiring plan of 5 new employees, which I want to do it in a phased manner. Okay. And average CTC would be a 6 lakh rupees per annum. Office rent is 1,50,000, electricity, software subscription. I put marketing budget, which is 5% of my revenue. Typically, this is what I want to keep as a budget. Then there is a travel 60,000, legal and professional fees of 40,000. There is an insurance, repairs, and miscellaneous of 30,000. Now, these are my cost assumption. Then I've got my financing that there's an outstanding loan of 50 lakh rupees, which I'm paying interest of 12%, which comes to a monthly EMI of approx 1,15,000. Then there is an income tax of 25%. And I typically TDS is getting deducted at 10%, and the business owner typically draws 2 lakh rupees per month. It's very important that you have a right set of assumptions in place. Now, once the assumptions are put in place, you're going to get a monthly P&L budget. Now, this is what a typical P&L look like. You've got your gross revenue, you've got your bad debts, which is a net revenue, then COGS, gross profit, then operating expenses, then there's an EBITDA. We are talking about gross revenue. Then I have got all my operating expenses, which is spread over month for the next 12 months. Then I've come up with my EBITDA, and then below EBITDA, it's my EBITDA margin, how much margin I'm earning on my business. Then there is a depreciation, interest on loan, profit before taxes, and what is my PAT margin. This is what profit I'm earning after paying out taxes. Now, you need to ensure that you're not just preparing only an Excel sheet, okay, with an assumption. You're going to go more deeper into every aspect of your revenue. Now, I have prepared a separate sheet of revenue in terms of I have taken up base of my existing customers. Now, existing customers are customer A, B, C, D, E, and how much revenue I'm expecting from each of these customers. If I have spoken to all my customers, I have talked to them about what kind of an orders I can expect from them, and that's how I have built my revenue assumption. Then there is an PF and ESIC, how much I'm paying month over month, and then what are the new hires. Okay, typically I'm going to hire one employee in June, one employee in August, one employee in October, and one employee in December and in February. Because I'm not going to hire all the employees in a 1 month. I'm going to phase it out over a period of time. So it's very important that the expenses have been phased out in a correct way. I have got my IT expenses, which is broken down month over month for the next 12 months. I have got my sales and marketing plan in terms of how much marketing is it a digital ad, SEO content, event, agency retainer. On top of that, what are my legal and professional fees? Typically CA, secretarial legal fees, and then I've got all my insurance and everything. Once all these sheets have been finalized and updated, that's where you're going to get your live P&L for the next 12 months. You should not jump directly to preparation of an P&L unless you and until you have studied out all these expense heads. Step number 3 is the most critical step where a lot of founders lose control on or they never reach to this stage, which is preparation of a cash flow budget. So once your P&L budget has been done, you should jump to preparation of a cash flow budget. Now, why there is a difference between P&L and a cash flow? Typically, when you raise an invoice, it gets reflected in your P&L, irrespective of whether you have received the money from the customers or not. However, in a cash flow statement, it is only going to get reflected when you have actually received the money. So, as a business owner, what would matter most to you is when have you actually received the money. And the cash flow budget is the place which is going to help you understand what are those gaps and in which particular month you're going to get those gaps. So it becomes easier for you to plan well in advance. Let's understand how does typically a cash flow would look like. Right now I put a 15 lakh rupees as my opening cash and then there is a collection of sales. Now, if you look at assumption sheet, we had put 45 days as a collection period. So typically, if I raise my invoice on 1st of April, I'm going to get money on 15th of May. Then you've got your GST input and then there is your cash inflow. Now we are supposed to make payments to our vendors, to our salaries, and there is a rent which you're supposed to pay, then there is an operating expenses, and then there is a GST payment, then there is a loan EMI, then there is an owner's salaries which they're getting, and then there's always an advance tax now inflow. Now this is basically which tells you whether your business is month over month positive or negative. If it's a negative month over month, then there's a serious gap in your business which you need to resolve quickly because you cannot survive a negative cash flow business over a period of time. And the lenders or the investors are going to finance you for a very limited period of time. They're not going to lend you for an infinite losses. So you need to ensure that your cash flow becomes positive after a certain point of time. Now you've got your budgets in place. However, you need to map out actual what have you actually achieved in this particular month and see the variances. If the variance is more than 10%, you should definitely act. And if the variance is more than 20%, there are chances the budget needs a realignment. As I mentioned, the budget is a living document. You cannot prepare once and forget it. There is a simple Excel sheet which you can use it out in terms of what is my revenue, what is my budget, the variance percentage. And then you can have notes or action items which you need to do as a management or as an CEO of the organization. This would help you to be on top of your budgets every month. This video, I would want to explain what are the 6 typical budget mistakes a lot of Indian MSMEs does and which completely kills out the purpose of why we are creating this budget. Number one is you're budgeting a revenue and you're not budgeting a cash flow. Number two, you're forgetting the GST outflow timing. As I mentioned, typically when you raise an invoice, it becomes a liability for you to pay to the government, irrespective of whether customer has paid those invoices to you within 10 days or within 90 days. You will have to make an outflow payment today itself. So you need to ensure that there is a proper cash flow planning well in advance. Number four, ignoring seasonality. Now, if you remember the model, we had a quarter three wherein typically a dip of 10% of your revenue. Now, you need to ensure, according to your business, if it's a seasonal in nature, what are those quarters where the revenue is going to go down, or what are those quarters typically a customer doesn't pay within the defined due dates. I need to ensure that your budget has been planned in such a way that it caters to those factors well in advance. Number fifth, just taking CTC as a number of your employee cost. Now, CTC is one aspect of your business. There is a fully loaded cost which becomes on top of your CTC, which is hiring cost, which is training cost, which is a software cost towards an employee. So whenever you're planning your employee relating costs, you need to ensure that you're taking into consideration a fully loaded CTC and not just a CTC. And number six, not separating personal and business. Now, if you have reached a stage wherein you can have a 3 separate accounts, I would highly recommend you have a 3 separate account. One is for an inflow account, second is for an outflow, and third is for your taxes or for your personal stuff. So it becomes very much easier for you to manage your business. So these are the 3 6 budgeting mistakes, which typically kills a lot of Indian MSMEs. Now, just to summarize our entire conversation, you're going to look at your previous numbers and then fill out your assumption sheet. On the top of that, you're going to prepare an P&L budget, which becomes your monthly P&L report, wherein you're going to start from revenue, your gross profit, your operating expenses. You're going to prepare a cash flow budget, which gives a clear picture of inflow versus outflow and what is the net cash impact on your business. A budgeting tool is not about predicting the future. It's about being prepared for it. If you have reached a stage of 20 crores and above, definitely you will need a help of a fractional CFO who can sit with your team and explain out the business budgeting process. If you have got someone, please speak to them and have aligned this process in place. And if you've not got anyone, you can speak to our team wherein we can help you out with annual operating plan for your business. Until then, see you in the next video.